Imagine it's a Tuesday morning in February 2016. You're a mid-level manager at a mid-sized company in Baltimore. Your name is David. You're not rich, not poor. You have a checking account, a savings account, a mortgage payment set to auto draft in 4 days, and a credit card balance you've been chipping away at for 6 months. You wake up, open your banking app, and the screen loads a little slower than usual. You don't think about it. You pour your coffee. You check again. The app gives you an error. Server issue, probably. You try the website instead. It loads. You log in. Your balance shows zero. Not a small number, not a suspicious transaction. Zero, as in the field is blank. You call the bank. The automated system plays for 11 minutes before a representative picks up. She tells you the bank is experiencing a technical issue and that your funds are safe. She cannot tell you when access will be restored. She cannot tell you what caused the issue. She asks if there's anything else she can help you with. There isn't, because you cannot reach your money. You check again at noon, still zero. You check at 3 p.m., same. By 6 p.m., a local news channel has a 2-paragraph story on its website saying the bank is investigating a cybersecurity incident. By 10 p.m., it's the lead story on 3 national networks. By the following morning, you know the word cyberattack, but you still cannot access your money. This is not a hypothetical. This is a composite built from documented incidents. The Bangladesh bank heist of 2016, the WannaCry attack of 2017 that froze the National Health Service across the United Kingdom, the Travelex currency exchange collapse of 2020 that left customers unable to access foreign currency for weeks, the Colonial Pipeline attack of 2021 that emptied gas stations across the southeastern United States not because there was no fuel, but because the payment and logistics systems were compromised. In each of these cases, the physical asset existed, the oil was in the pipeline, the money was in the accounts, the medicine was in the hospitals. The attack didn't destroy those things. It severed the connection between you and them, and that severing, it turns out, is enough. This is not theory, this is documented history, and once you understand what actually happens to your bank account in the first 72 hours of a cyber attack, you begin to see something uncomfortable about the infrastructure that mediates your entire financial life, something almost nobody explains clearly. Not your bank, not the news, not your employer. Let's go through it precisely. If you're enjoying this deep dive into the story, hit the subscribe button and let us know in the comments from where in the world you are watching from today. Before we talk about what happens to you, it's worth understanding what actually happens to a bank when it's hit. The public image of a cyber attack is a hacker in a dark room, bypassing firewalls, stealing data. Sometimes that's accurate, but the attacks that affect your account aren't always about theft in the traditional sense. They're often about disruption, about poisoning the mechanism of exchange itself. Modern banking infrastructure is not one system. It is dozens of systems, many of them legacy technology built in the 1970s and 1980s, patched together with middleware sitting beneath a digital interface designed to look clean and simple. COBOL, an ancient programming language, still processes an estimated 95% of ATM transactions and the majority of daily credit card swipes. The systems that display your balance, process your payment, and authorize your card are not the same system. They talk to each other through a series of translators. When a cyber attack hits, it often doesn't destroy data. It corrupts the communication between systems. It freezes the translators. It introduces inconsistencies that the bank's own software cannot reconcile. The bank's fraud detection systems, designed to flag anomalies, begin flagging everything and therefore nothing. The result is paralysis. The bank knows this almost immediately. What it doesn't know in the first hours is the scope. It doesn't know if the breach is contained to one system or 20. It doesn't know if customer data has been exfiltrated. It doesn't know if its reconciliation processes have been corrupted. Until it knows those things, it cannot safely open the gates. So it closes them. This is the decision you are not told about. Not a malfunction, not a glitch. A deliberate shutdown of access made in the first hours, usually before you've noticed anything is wrong. The first thing that happens in a serious cyber attack against a financial institution is that nothing appears to happen to you. This is by design, and it is one of the most dangerous aspects of the event. Banks have crisis communications playbooks. Those playbooks universally prioritize one thing above all others: preventing panic withdrawals. The second a bank announces it has been compromised, it risks a bank run. Not a digital one, but a physical one. People lining up at branches, people flooding call centers, people moving funds to competitors, stressing the interbank transfer systems, creating a secondary crisis on top of the primary one. So the initial posture is always containment and silence, a terse statement acknowledging a technical issue, a reassurance that funds are safe, a promise to update customers as more information becomes available. During this window, you are in a peculiar position. You may not be able to log in. Your mobile app may return errors. Your card may be declined at a restaurant or a gas station. But you don't know why. You cannot know why. The bank is not telling you. In the 2017 WannaCry attack, National Health Service staff in the United Kingdom showed up to work and found their computer screens displaying a ransomware demand. Surgeries were canceled, ambulances were diverted, patients were turned away. The public did not receive a clear explanation of what was happening for hours. During that window, patients, families, and employees were operating on incomplete information in a situation where incomplete information could be fatal. The silence is not malicious, but it is structural. It is built into the incentive of every institution under attack, and in that silence, the gap between what is real and what you can access widens. By the end of the first day, the effects begin compounding. Auto payments begin failing. If your mortgage, rent, utilities, or loan payments are scheduled to draft from the affected account, they will attempt to process against a frozen system. Some will fail and retry, some will simply fail. The billing systems on the other end do not know why. They register a declined transaction. Depending on the institution, this may immediately trigger a late payment notice, a penalty fee, or in the case of some loan servicers, the beginning of a delinquency record. Your credit score does not know you were the victim of a cyber attack. It knows a payment was missed. This is not theoretical. After the 2021 CNA financial cyber attack, one of the largest insurance companies in the United States, systems were frozen for weeks. Employees could not access internal tools. Policy records were inaccessible. Customers trying to make claims found themselves in a processing void. The cascade of downstream failures from a single institutional freeze extended far beyond anything the headline numbers suggested. Credit cards, if issued by a different institution, may still work. But if your primary account is frozen and you have limited credit available, you are now rationing. Groceries, fuel, medicine. You are making triage decisions in a situation you didn't anticipate, with a timeline you cannot predict. ATMs present a separate problem. Even in cases where your bank's ATM network technically functions, daily withdrawal limits exist. If a cyber attack causes the bank to lower those limits as a precautionary measure, which has happened, you may find yourself limited to a few $100s per day, regardless of what you have on deposit. The cash in the machine is finite. Other customers are withdrawing simultaneously. By midday, many machines are empty. This is the point at which cash, physical cash held outside the banking system, becomes relevant in a way that most people haven't thought about since the 1990s. Not because cash is inherently superior, but because it is the one form of liquidity that does not depend on a digital intermediary to function. By the second day, if the attack is significant enough to make national news, you are now operating in a deteriorated information environment, and this creates a second-order problem. Misinformation spreads faster than official communications. Rumors about the scope of the breach, about which accounts are affected, about whether data has been stolen, circulate before the bank has completed its own forensic assessment. Some of those rumors will be true, some will be exaggerated, some will be deliberately seeded by actors who benefit from panic or from eroding trust in the institution. You cannot tell the difference. Neither can most journalists. The bank's own communications are carefully worded to minimize legal exposure, which means they are carefully worded to minimize clarity. You are reading between lines that have been drafted by lawyers. In 2020, when Travelex was hit by the Sodinokibi ransomware attack on New Year's Eve, customers who had loaded travel money cards found themselves unable to use them for weeks. Travelex initially described it as a software service issue. The word ransomware did not appear in their public communications for days after it was already widely reported by security researchers and journalists. By the time a clear picture emerged, the damage to customers was done, and the damage to Travelex itself was terminal. The company entered administration later that year. The gap between what an institution knows and what it tells you is not necessarily fraud. It is the natural product of legal caution colliding with operational chaos during an active incident. But the effect on you is the same. You are making decisions about your financial life with information that is incomplete at best and deliberately managed at worst. This matters because many people in the second 24 hours make decisions they later regret. They try to move money using methods that are also compromised. They make calls that place them in social engineering traps. Fraudsters who monitor public news of cyber attacks actively call customers of affected banks, posing as security teams. They have the name of the bank, the name of the incident, and a plausible script. In the 48 hours following a major banking breach, fraud attempts against customers of the affected institution spike dramatically. You are not just dealing with a frozen account, you are dealing with a targeting environment. If you find this story engaging, please take a moment to subscribe and enable notifications. It helps us continue producing in-depth content like this. By the third day, a dimension of the crisis emerges that almost nobody anticipates. It's not about your balance, it's about settlement. Modern banking does not operate on real-time finality. When you make a purchase, what happens in the background is a series of provisional entries, promises, that are reconciled in batches. The actual settlement of transactions, the moment money truly moves from one institution to another, happens on a cycle, often overnight, often through clearing systems like the automated clearinghouse in the United States or similar infrastructure elsewhere. When a major institution is compromised, those settlement cycles break. Transactions that appeared to clear begin reversing. Payments that appeared to post begin disappearing. The bank's own records of what you're owed versus what you owe become the subject of reconciliation processes that can take days. During that window, your true balance is, in the strictest sense, uncertain, not fraudulently uncertain, procedurally uncertain. Think about what that means. The number on your screen has always been, to some degree, an approximation, a reflection of a highly sophisticated but ultimately fragile settlement system operating in the background. In normal times, that system is fast and reliable enough that the approximation feels like a fact. In a breach, the approximation is revealed. This is what happened in 2012 when Knight Capital, a major trading firm, was effectively destroyed in 45 minutes by a software malfunction. $440 million vanished from the firm before anyone could stop it because the systems executing trades moved faster than the humans monitoring them. It was not a cyber attack in the traditional sense, but the mechanism, automated systems making irrecoverable decisions faster than human oversight could intervene, is identical to what happens in a coordinated cyber attack on banking infrastructure. The settlement problem is why bank restorations after cyber attacks are not simply a matter of flipping a switch. The bank has to audit every provisional transaction from the period of the breach, reconcile them against counterparty records at other institutions, and then reconstruct a state of accounts that all parties can agree is accurate. That process takes time, and during that time, any attempt to rush restoration risks compounding the damage. Your 3 days may become 5. Your 5 days may become 10. Let's step back from the sequence of events and look at the underlying structure, because this is what the news coverage almost never explains. Your bank account is not a box. It is a ledger entry in a system of interconnected ledgers, each of which depends on other ledgers, none of which is fully authoritative on its own. Your balance is a consensus, a convergence of records held by your bank, by the payment networks that process your transactions, by the clearinghouses that settle them, and by the counterparty institutions involved in each transaction. That consensus is maintained by software that was written by humans, that runs on hardware, that depends on network connectivity, that communicates through protocols. Every link in that chain is a potential vector for disruption. The reason this matters is that it reframes the nature of what you own. You do not own dollars in the way you own a physical object. You own a claim, a right to demand that the ledger entry representing your balance be converted to physical currency or transferred to another ledger entry on demand. That right is real, it is legally protected, but its exercise depends entirely on the infrastructure that mediates it. This is the exchange assumption at work in its digital form. In normal times, the assumption that you can access your money whenever you want is so reliable that the distinction between owning a claim and owning the thing itself feels academic. In a cyber attack, it becomes everything. The lesson of the last 2 decades of financial cyber attacks is consistent, and it rhymes with the lesson of every other form of systemic disruption throughout history. The people who weather the disruption best are not those with the most money in the affected system. They are those with the least dependence on the affected system at the moment it fails. The Kenyan economy, for reasons of geography and development, built robust mobile payment infrastructure, M-Pesa, that operates largely independently of traditional banking. When global banking systems face disruptions, Kenyan mobile payment users experience much of it as noise rather than crisis, because their financial infrastructure doesn't sit on the same stack. The resilience wasn't the result of more sophisticated technology. It was the result of different technology with different dependencies. Retired farmers in rural communities who kept physical cash, who paid in person, who stored a portion of their savings outside the banking system for no reason other than habit or distrust, often fared better in the 72-hour window of a financial cyber attack than urban professionals managing their entire financial lives through a single banking app. Not because the farmers were smarter, because they had unintentionally maintained optionality. They had not concentrated all of their financial access through a single digital chokepoint. This is the pattern, and it is visible not just in cyber attacks, but in every form of systemic disruption throughout history. The people who survive best are rarely those with the most stored in the system. They are those who maintain the ability to function outside it. Here is what people typically need access to in a 72-hour window when normal financial infrastructure fails. Cash for immediate purchases. Groceries, fuel, medicine, incidentals. Not a fortune. The research from regional disaster events consistently shows that the amount most households actually need to function for 72 hours without electronic payment access is smaller than most people imagine, typically a few $100s. The problem is not the amount, it's that almost nobody holds that amount outside the banking system in a form they can access without a card. A secondary payment method at a different institution, credit cards, prepaid cards, or accounts at a second bank that is not affected by the same breach. The probability that two unrelated institutions suffer simultaneous identical attacks is low. Diversification across institutions is the financial equivalent of not putting everything in one place. Awareness of automatic payment schedules, knowing which payments are set to draft during a vulnerability window, and having a way to notify the receiving institutions proactively can prevent penalty fees and delinquency marks that are difficult to reverse. This requires knowing your own financial schedule, which many people, relying entirely on automated systems, have never mapped out explicitly. And information hygiene, the ability to distinguish legitimate communications from the affected institution from social engineering attempts that will inevitably follow in the wake of a public breach. The rule is simple and absolute. Do not respond to inbound contact from someone claiming to be your bank. If you need to speak to your bank, you initiate the call using a number from the back of your card or from the official website you navigate to directly. None of these are expensive. None of them require gold or a bunker or a financial advisor. They require a small amount of deliberate preparation and an accurate mental model of what your financial life actually depends on. There's a reason this preparation is rarely discussed. Banks do not benefit from reminding customers that digital access to their accounts can be severed without warning. The entire consumer banking model depends on the perception of seamless, frictionless availability. The more a customer integrates their financial life into a single institution's app, the stickier the relationship, the harder it is to leave, and the more valuable the customer is. The cybersecurity industry benefits from selling enterprise solutions to banks. It does not have a significant commercial interest in individual financial resilience. The product is institutional, not personal. The media covers cyber attacks reactively, after they happen, in a frame of technical specifics and corporate malfeasance. It rarely covers the structural vulnerability that makes individuals exposed. That story is less dramatic and less time-bounded. It doesn't fit the news cycle. So the information that would most benefit you, the clear-eyed explanation of what actually happens to your account in the first 72 hours and what you can do about it, has no natural distribution mechanism. No one profits from it spreading, and so it doesn't. This is not conspiracy. It is incentive structure. The ideas that get marketed are the ideas that benefit from being marketed. The ideas that don't have a commercial sponsor don't get the same reach. The result is a population that is, by and large, entirely unprepared for an event with a documented and rising probability. Let's be precise about likelihood, because this matters. Since 2015, the number of significant cyber attacks against financial institutions globally has roughly doubled every 2 years. The attacks are increasingly sophisticated, increasingly coordinated, and increasingly targeted at infrastructure rather than individual accounts. The goal is not always theft. It is often disruption, leverage, or the demonstration of capability. In 2023 alone, the MoveIt data breach affected hundreds of organizations, including multiple financial institutions and government agencies. The Scattered Spider Group compromised major casino and hospitality companies with techniques that had direct applicability to banking. The Alf V ransomware group listed targets explicitly including financial infrastructure. The question is no longer whether a significant cyber attack will affect a major financial institution that ordinary people depend on. That has already happened, repeatedly. The question is whether, when it affects the institution that holds your money, you will be among the people who notice but adapt, or among the people who find themselves rationing their last physical $20 bill on day 2, unable to pay rent, having their credit score dinged for a missed auto payment, and unable to distinguish the real update from the bank from the fraudster calling 5 minutes later. That gap between adapting and not adapting has nothing to do with wealth. It has to do with structure, with how you've organized your financial dependencies before the event. A parallel to the historical examples of systemic disruption is not accidental. It is the same mechanism operating on the same vulnerability. When the infrastructure that mediates exchange fails, what matters is not what you have stored in that infrastructure. What matters is whether you have preserved any capacity to function outside it. That capacity is not expensive, it is not exotic, it is not the province of preppers or survivalists or the financially sophisticated. It is simply the maintenance of optionality. The deliberate refusal to route every aspect of your financial life through a single digital choke point. Physical cash, accounts at multiple institutions, a mapped understanding of your own automatic payment schedule, the habit of initiating rather than responding when something seems wrong, a mental model of what your financial life actually depends on, not what the app makes you think it depends on, but the infrastructure underneath it. These are not investments. They don't appear on a balance sheet. They can't be traded or liquidated. But they are the difference between 72 hours of inconvenience and 72 hours of crisis. Every major financial institution in the developed world has experienced either a significant cyber attack or a near miss in the last decade. The probability that this pattern pauses is close to zero. The incentives for state level and criminal actors to target financial infrastructure are increasing, not decreasing. The complexity of the systems being defended is increasing, not decreasing. The attack surface is expanding with every new integration, every new app, every new digital dependency layered onto already fragile legacy systems. The first 72 hours of a cyber attack are a controlled experiment in what your financial life looks like when the exchange assumption breaks. Not permanently, not catastrophically, just temporarily. Just enough to reveal every dependency you didn't know you had. The question is not whether that experiment will run again. It will. The question is whether, when it does, you will have organized your life in a way that treats the digital infrastructure as what it actually is, a powerful but fragile convenience, rather than what it feels like, an inviolable fact of modern existence. History suggests the distinction between those two framings is everything. This channel exists to trace these patterns before they become personal. If this analysis is useful, subscribe. The patterns are already in motion. The better question is always whether you see them before you need to.